If you co-own a home in New South Wales with a family member or a business partner or through a fractional investment syndicate, you need to listen very carefully to this warning. A silent massive change is currently hitting thousands of New South Wales households with unexpected land tax bills worth thousands of dollars. Most people believe that if a property is your primary place of residence, it's automatically 100% exempt from land tax. But under a strict New South Wales law, if you own even a slightly minor share of the home you live in, the government is about to strip away your tax exemption. Today, we're uncovering the New South Wales 25% principal place of residence trap, why the transitional safety net is officially gone, and how you can legally restructure your ownership before the next taxing date. First, let's look at the rule that is catching families completely off guard. To qualify for the principal place of residence land tax exemption in New South Wales, any person who occupies the property as their home must hold a minimum 25% ownership interest in that property, either solely or jointly. Historically, many families used co-ownership structures to help their children get onto the property ladder. For example, a parent might buy 90% of a home as an investment while their child buys 10% share and moves in as a primary resident. Under the old rules, because one of the owners lived in the property as their home, the entire property could qualify for a land tax exemption. But the New South Wales government just changed the law, requiring a minimum 25% stake. So while they offered a transitional relief for existing co-owners, those transitional provisions are officially expiring. If the person living in the home owns less than 25% share, the property loses its PPR exemption, exposing the entire asset to annual land tax assessments. To make matters worse, let's look at how the tax is calculated and who is classified as a foreign person. In New South Wales, the general land tax is charged at a rate of 1.6% plus $100 on the combined unimproved land value of your taxable properties above the threshold, which currently sits at $1,075,000. But if you're deemed a foreign person, you just get hit straight away with an additional 5% foreign owner land tax surcharge. You see, unlike the standard land tax, the 5% surcharge has absolutely no tax-free threshold. You pay it from the very first dollar to your property's unimproved land value. And here is the trap for permanent residents. Under Revenue New South Wales rules, even if you hold an Australian permanent residency visa, if you live overseas for 165 days or more per calendar year, you're classified as a foreign person. If you're a permanent resident, for example, working overseas on a contract, or a co-owner who falls below the 25% threshold, you're suddenly exposed to a combined land tax and surcharge liability that can top 20, it probably cost you 20 grand a year on a standard suburban block. So if you think you might be exposed to this trap, you must act before the next taxing date on December 31st. Here's your playbook. First, get an immediate ownership audit. Check your land titles and mortgage documents. If the resident co-owner holds 10 or 20% stake, you don't qualify for the exemption. Second, consider transferring equity. Speak to your solicitor and accountant about transferring enough share in the property to the occupying co-owner to bring their total interest to at least 25%. While this transfer may trigger partial stamp duty, paying a one-off transfer duty is often far cheaper than paying thousands of dollars in recurring land tax year after year. Third, review your family trusts. If your property is held in a discretionary trust, the trust is automatically hit with a maximum surcharge land tax if any of the potential beneficiaries are foreign persons. You must work with your lawyer to legally amend your trust deeds to exclude foreign persons as beneficiaries to protect the asset. New South Wales property tax rules are getting tighter, and a simple structural mistake can cost your family tens of thousands of dollars in unnecessary tax. To make sure you are always structuring your property portfolio the smart way, make sure you hit the subscribe button right now, and I'll see you again on the next one.